I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally on the dollar, and we're bottom here and can go higher.
From April 9th through early October, Bitcoin reached new all-time highs. For many in the crypto community, this surge was interpreted as proof that institutions were finally piling in with conviction, especially through the iBIT ETF, BlackRock's massive Bitcoin ETF product. At the same time, digital asset treasury companies, the so-called DAT companies, were issuing debt and equity to purchase Bitcoin. Together, these two forces created the appearance of a deeply committed institutional bid for Bitcoin. Retail traders interpreted the flows as proof that smart money was finally here for good. But Arthur Hayes argues that this interpretation was completely wrong.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
What we saw from sort of April 9th until October was Bitcoin hitting an all-time high. And this was driven by, I think, people misunderstanding what's going on in the ETF space, especially the iBIT ETF, the BlackRock Bitcoin ETF, the largest ETF out there that tracks Bitcoin, and the digital asset treasury company space, the DAT space, and the issuance of debt and stock to purchase Bitcoin. And these two things essentially added the impression that there's this big institutional bid for Bitcoin, and therefore the Bitcoin sort of ignored the fact that about $1 trillion was removed from the dollar liquidity markets at least from July until the present. And basically, once the ETF inflows switched to net outflows and DAT companies went from trading at premiums to trading at par, if not a slight discount, then Bitcoin basically fell down to where it should have been based on the dollar liquidity situation. Wall Street, retail, they're piling into these ETFs. And yes, that is true. But as traders and investors, we care about who is the marginal buyer and seller of a particular asset. What are the flows? And so, I have my trusty Bloomberg chart up here. You put up an HDS, the largest holders of the iBIT ETF on Bloomberg, or whatever platform you use, you'll see, and I'll name them here, Brevan Howard, Goldman Sachs, Millennium, Avenir, Jane Street are the largest 5 traders of this thing, right? There's a chart in my recent essay.
That's right.
And if you understand anything about what these businesses are, they're either multi-strat pod shops who trade hedge funds, they're global investment banks, and one of them is a family office for the founder of Huobi, Avenir. And so these entities are not places where they're just going to go long Bitcoin. Like Izzy doesn't give a fuck about Bitcoin. Alan Howard loves Bitcoin, but it's not like the key thing in his Brevan Howard asset management company where he manages clients' money. What they're in the business of doing is borrowing money and finding great ways to deploy that with high Sharpe ratios. And that would be a basis trade. So what are these guys doing? They're taking the iBIT ETF, they buy it, they pledge it with their broker, then they sell a futures contract on the CME against it, and they were making, let's call it 7 to 10% per annum on that trade. They fund at Fed funds at 4-ish%, and they lever it up, and that's a great levered return for these type of investors. Now, as that funding rate declines, and it has declined in September and October, then these traders unwind this position by selling the ETF and buying back their futures contracts. So during the summer, we saw massive net inflows driven marginally by these large players. And then as soon as that basis fell, especially after October 10th on the massive liquidation event, then you see net outflows. And so the retail thinks, oh no, institutions love Bitcoin in the summer and now they hate it in the fall. Therefore, I need to get rid of my exposure as well, not understanding what was driving those flows in the first place. And then on the DAT space, if you have a low MNAV or even at a discount, it's very difficult to issue corporate securities and purchase Bitcoin in a net positive accretive manner for your stock. And therefore, either you stop doing it altogether, you slow down, or you start selling Bitcoin and buying back your shares if you're trading at a discount, which again removes this impression that there's this new cohort of assets or of capital that is coming into the Bitcoin space. So when we remove those two things, and then I post that, you posted my chart of the difference between the price performance of Bitcoin and the percentage change in the dollar liquidity, then Bitcoin says, okay, I'm going to react to where I should have been, absent the shimmer of these flows, and that's the move from 125,000 to 80,000. But more importantly, especially for this time around, it's the cessation of quantitative tightening at the Fed. So this program that the Fed started running in 2022 of reducing their balance sheet is over. Now the balance sheet will be kept constant, and obviously most analysts believe that the Fed is going to restart quantitative easing at some point for whatever justification that they give. It doesn't really matter. All we know is that we have essentially bottomed on the liquidity chart, and the direction in the future is higher. And so that's why I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally, on the dollar, and we're bottom here and can go higher. They're always printing money. The question is how they do it. Now, we've been talking about the Federal Reserve. I also monitor the commercial banking system, and starting in November, the thing that I monitor is other deposits and liabilities and the amount of securities that the commercial banking system holds in the United States. That sort of bottomed, and we're starting to see an uptick in bank lending. And that makes sense if you read the headlines. JP Morgan's talking about $1.5 trillion of lending they're going to do to the industrial sector. The US government is talking about industrial policy where they'll guarantee a certain amount of purchasing power of rare earths, semiconductors, what have you, to inspire entrepreneurs to build things and get a bank loan to do that. So if this, industrial revolution financed by the banks, this is what Besson and Trump campaigned on. This is what they want to do. They still haven't been able to really start actualizing that. But I think in 2026, we're going to see more evidence of that. Then we're going to see more credit creation coming from the banking system rather than the Federal Reserve. But the fact that quantitative tightening is ending is very important, because at least we don't have this drag of the Fed removing something somewhere to the close of, I think, $2 or $3 trillion from the system from 2022 onwards.
In 2023, Treasury Secretary Janet Yellen had a key tool, the reverse repo (RRP) facility, with $2.5 trillion sitting idle. She issued short-term debt, pushed yields above RRP rates, and successfully drew trillions out of the facility, injecting that money into markets and fueling a global bull run. In 2025, however, Treasury Secretary Scott Bessent did not have a massive RRP pool to draw from. So when the government raised the ceiling and issued $1 trillion in debt, liquidity contracted sharply. Combined with the Fed's ongoing QT, nearly $1 trillion was removed from the system between July and now. That liquidity drain is the underlying macro reason Bitcoin dropped.
I don't think people understand the amount of effort that it takes to be a leveraged trader. I think people say, I can get 100x leverage or whatever trading crypto versus I can get 2 or 3x trading stocks or some leverage ETF. This is great. I'm going to make a lot of money. But they're not willing to put in the effort to be a professional trader. But that what I mean, like 24/7 on your phone. Like you live and breathe these crypto markets. People think that I'm going to get off of work and trade leverage crypto for a few hours and I'm going to somehow make money. No, you're going to get liquidated. If you're just trading crypto a few hours a day, you're not reading what is an automatic deleveraging event, how do exchanges mark your positions. And you don't understand these idiosyncratic things about the market structure that you should as a proper professional trader if you put all your effort into this. And that's where most people got wrecked in October 10th. It wasn't some conspiracy by CZ and Binance and the market makers to take away your money. It was you were lazy, you didn't read the documents that have been up for years. I mean, I invented this shit 10 years ago. We wrote about it. You should have no excuse not to know what this stuff is and how it works. And if you didn't agree with the exchange policy, you should never have been trading it. So I have no sympathy for people who lost money on October 10th, except for people who had API issues on Binance. There's no excuse. If you are a proper trader, you should not get liquidated, period. End of story. It absolutely can go to 10K. I think that the Tom Lees of the world, he's spinning a great narrative for his user base, which are TradFi asset allocators and heavy retail traders in the Western markets. And his thesis is, okay, banks all of a sudden now want to do Web3. The most secure chain to do Web3 on is Ethereum, and therefore either they'll build their own L2 or use L2s that are out there, or use the Ethereum mainnet in and of itself. And this is going to drive usage of the chain. And that's going to be the institutional DeFi narrative. And I like that narrative. Whether or not it's true is kind of irrelevant. I think it makes sense to the people that he's selling it to. And coupled with a supportive macro environment, this will be what generates ETH to the $10,000 to $20,000, I think, price by the end of the cycle. There's a pod, and a pod has a funding strategy mandate, right? These guys have equity, long, short. They have all sorts of different strategies. There's a portfolio manager, and their team will put on these types of funding trades. Could be bond RV. This is, it's a basis trade. It's a very standard trade, across all different types of ETFs that you can do. I buy the ETF and I short a future on the underlying and I trade the difference. And this is I used to do this as a career back in the day as well. So it's a very easy trade, especially when you can fund very cheaply at Fed funds. And then essentially you double the interest rates that you receive and you look like a hero because again, you're just trying to make 10%. If you make 10% for Izzy, you're making $50 a year. So this is what you need to do.
Right. Yeah. So and that funding rate goes down. Why? You said that already, but I just want to understand that.
As the price declines, then the funding rate collapses. In 2023 and in 2025, there is a political theatrical fight about the debt ceiling in the United States, where both in 2023 it was the Democrats in charge. In 2025 it was the Republicans in charge. Same issue. One side wanted to spend a bunch of money and raise the ceiling. The other side tried to feign that they gave a fuck about fiscal responsibility, and so they fought the opponent. And then at the end of the day, of course, the government's not going to go bankrupt itself by not paying out, so they raise the ceiling. But all the while that this fight goes on, the Treasury has to spend down its checking account. And when the U.S. Treasury, or any Treasury department for that matter, spends down their checking account, they're adding fiat liquidity to the system. And so this is helps the markets. But as soon as the ceiling is raised, now the Treasury needs to refill its bank account. And by doing that, they issue debt. And instead of spending that money that they raise from the market, they keep it in the bank. And that extracts liquidity. So in 2023 and in 2025, it was June in 2023 and July in 2025, you had in the order of, half a trillion to $1 trillion that needed to be raised by the U.S. Treasury. And so as they start to do this, then the dollar liquidity contracts, and this has an adverse effect on all types of risky assets, Bitcoin and stocks predominantly. Now in 2023, this led to sort of a 20% sell-off pretty quickly in the S&P. The 10-year yield was rising almost close to 5%. And again, the goal of every administration in the United States and every government around the world is to keep the stock market high because they earn taxes and makes the rich people feel good and all these sorts of things. So Janet Yellen had to find a way to juice the markets. Now, back in 2023, there was this facility at the Federal Reserve called the Reverse Repo Program, and it had $2.5 trillion of funds basically left over from the COVID stimulus era that was sat inert on the Fed's balance sheet. So what Janet Yellen did was said, okay, I'm going to issue more Treasury bills, short-term Treasury debt, less than 1 year maturity, and such a quantity that the yield is going to rise so much so above the reverse repo yield that it'll entice those funds to take that money out of the Fed's bank account and put it into the financial markets by lending it to the U.S. government, which then goes and spends this money. And so from 2023, third quarter, until essentially January 2025, Janet Yellen's Treasury injected $2.5 trillion of liquidity into the US dollar money markets. And that is essentially the reason why everything across the world ripped. Bitcoin, stocks, gold, housing, whatever, right? That is the reason for that bull market. And that sort of ended in early 2025. That's important because when U.S. Treasury Secretary Scott Bessent under President Trump in the United States did the same thing starting July 4th when the debt ceiling was raised. He had to raise $1 trillion to refill the Treasury's general account. He didn't have this reverse repo program with $2.5 trillion sitting in it to tap to basically nullify this negative liquidity effect. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets. Now, in the stock perspective, it's really the AI hype and bubble that's kept the stock market elevated. And in Bitcoin's case, it was the ETF flows and this DAT flows that we just spoke about that really counteracted this negative liquidity effect.
Arthur Hayes' core message is powerful. Bitcoin didn't pump because institutions fell in love with it. Bitcoin pumped because arbitrage traders temporarily distorted flows. Bitcoin didn't crash because institutions lost faith. Bitcoin crashed because liquidity was drained from the system. Now that liquidity drain is ending. QT is over. Commercial credit expansion is beginning. Future QE is likely. And the artificial ETF and DAT distortions have washed out. In Arthur's view, the $80,000 region is the macro bottom, and we are entering the early phase of the next liquidity-driven expansion. Is $80,000 truly the bottom? Are we about to enter a new liquidity cycle?